Happy day, guys. The road program is back. Sorry it's been a couple of weeks since I posted some content, but I've been getting ready to retire, trying to figure out how to move the family, including our obese cat, across the Atlantic Ocean, trying to sell a car, doing my medical, and packing up our entire household. But none of that matters, because right now it's just you and me here. Well, actually, you're there, and I'm on your screen. We're about to cover one of the most important topics on the road program: investing. So stick around for 6 things you should know before you invest in the stock market. I want to take a second to welcome all the new subscribers. We're closing in on 300 subs. And if you're watching this episode and you're not part of the road program community, I invite you to like and subscribe to the channel, where we cover personal finance, career development, and transition from military to civilian life. Thanks, it really helps out the channel. So let's start with a quick disclaimer. I'm not a financial advisor. I don't know your personal financial situation, and the market is literally unpredictable. You have to do your own research when it comes to investing. I'm just here to give you some tools for your toolbox. You hear me talk about it, you hear your friends, neighbors, and coworkers talk about it. They're figuring out when they're going to make their big Carnival Cruise Lines move, stoked about how Tesla is blowing up. Well, today we're covering the very basics, and more importantly, we're covering some concepts that you should understand so you can have confidence going into the stock market. The stock market is like any other market. Buyers and sellers come together, in this case, to buy and sell stock. Stock, also known as equity, is fractional ownership of companies. Units of stock are called shares. So if you buy 1 share or even a fractional share of Tesla, you and Elon Musk are now partners. Individual stock price is driven by confidence in future performance of the company. If people think that a company will continue to succeed and grow, then they'll buy shares of that company, causing demand, which will drive prices up. We're going to cover a lot of ground today. Some of these topics really deserve a video of their own, so I'm just going to touch on them, but we'll get deeper in future episodes. So here are 6 concepts you should understand when investing in the stock market. Number 1, the stock market is headed up. Hourly, daily, or even weekly, the stock market can sometimes be tracking like a heart rate monitor. Monthly and yearly, there can be major corrections that reset the stock market at a much lower level. But you gotta understand that the overall trend is up. The more that you zoom out, the clearer that big picture is. Nobody can predict the day-to-day fluctuations of the stock market, but with historical data, we can have a pretty good idea of the long-term outlook for the stock market. I know that one of the worries of people is losing all of their hard-earned cash, but not to worry if you're investing strategically. For you to lose all of your money, you'd have to have some sort of global event that brings the entire economy to a screeching halt for a sustained period of time. But even a global pandemic like COVID-19 hasn't scared away all of the investors. Whether you agree or disagree with the actions governments around the world have taken to protect corporations, businesses, and individuals, those actions have been enough to keep the stock market from completely tanking, even though there was an initial dip as COVID really started to take hold. To see exactly how the stock market is doing, let's take a look at some of the indexes. Indices? According to Google, both indexes and indices are correct, but I'll go with indexes. Overall, the stock market took about a 30% dive between February and March of this year. That means that a lot of companies lost about a third of their value. The NASDAQ, which is mostly technology and internet-based companies, has not only caught up from that 30% drop, but has set all-time record highs. The S&P 500, which is a stock index that covers the 500 biggest companies in the United States, is only 5% off its pre-COVID level. And who knows what the future holds? Maybe the long-term unemployment for so many people and the closing back up of a lot of businesses means either another dip or a dive is on the way. So let's take a closer look at the last big stock market dive, which happened in 2008, a couple years after the big housing market fiasco. If you were invested in 2008, your money got slashed in half. If you had $200,000 and all of a sudden you were looking at $100,000 in investments. But if you had stayed the course and kept your money in the market, that $200,000, which became $100,000, would now be worth about $800,000. And that's including the dip from COVID-19. Number 2, buy low and sell high. It seems really simple, right? If you want to make money, you sell shares at a higher cost than you bought them. So why do so many people get it wrong? It goes back to that unpredictability. human nature, and perception. I know, it's tough when you log in and see those red numbers and your stock value heading downward. Most people's initial reaction is to cash out and keep from losing any more money. You have to look at the overall circumstances and what's causing that drop, but a lot of times, significant drops can be real opportunities. Those red numbers are only the current value of your shares. If you ride it out and give your positions time to recover, then those numbers can go back up to the green. The key point here is you only actually lose money or have realized losses if you cash out at a lower price than you bought in. On the other hand, you only have realized gains if you cash out at a higher price than you bought in. So even if you were killing it with Blockbuster, if you didn't sell those shares, then you have virtually nothing now. So how does buy low and sell high work? Well, let's take a look at COVID. When COVID really started to take hold, there was a lot of people that were really nervous about their investments. But there was also a large portion of investors who were really excited about the opportunities. Over the course of about a week and a half, I had a running conversation with my wife, Lindsay. We decided to move a significant portion of our savings into our E-Trade account to take advantage of some of these discount stocks. The confidence lost in the overall market because of COVID meant that we saw a lot of buying opportunities. Our strategy? It was to invest in blue chip companies that were big enough and strong enough to ride out the COVID storm. Here's a list of all the companies that we decided to invest in. The last three, Uber, Zynga, and DraftKings, were more speculative, but the rest of these are very solid companies. And here's a look at how all of our post-COVID investments have fared up to this point. The only companies that are in the red are companies that are heavily reliant on moving people around. But as soon as everything starts to lift, I expect to see Delta, Southwest, Carnival cruise lines really pick up. But remember, I haven't lost or made anything until I actually cash out. That gets back to realized gains and realized losses. Number 3, time in the market beats timing the market. So here's a key point. Oftentimes, the biggest gains come after big losses. Other than getting lucky, nobody's found a reliable way to mark the bottom as stocks are headed downward. Unless your money's already invested, you're most likely to miss those biggest gains if you're keeping your money out of play, waiting for that perfect opportune time. The market big gain days are critical to your investments. Here's a graphic of a study conducted by Fidelity. They put together a hypothetical situation of a $10,000 investment made in 1980 and going until 2018. That's a period of 38 years or almost 14,000 days. Of those 14,000 days, if you just miss the 5 best days, then that slices your profits down by 35%. Granted, you're still making money, but you've just sliced off a huge chunk of your earnings. The big point here is don't try to time the market. People much smarter than you and me have failed to do so time and time again. Just get your money into play and grind it out with good fundamentals and you'll be set. Number 4 is build yourself a diverse portfolio. Yes, the overall market is going up. Individual companies can make mistakes and underperform. Individual companies can fail to innovate, fail to stay ahead of the competition, or fail to adjust to changing markets. You need to protect yourself and have a diverse portfolio. If all your money is invested in airlines, you were and are still taking a beating right now. But one way that you can invest in multiple companies or multiple sectors is to utilize mutual funds. Mutual funds are funds that own pieces of several companies. They can be structured aggressively or conservatively. They can be diversified or specialized. By investing in mutual funds, you're avoiding putting all of your eggs in one or two companies' basket and spreading them out so that you can follow the overall trends of the market. You can diversify what you're investing in, and you can also diversify when you're investing. One way to mitigate some of those ups and downs in the market is dollar cost averaging. Dollar cost averaging means that you're investing a fixed amount of money on fixed intervals. Kind of like how you invest in your 401k. It's a safer way to start building up your investment, and in the long run, you're probably going to outperform somebody who's taking all of their money and waiting to pounce and time the market. Number 5, don't be emotional. Just like playing blackjack at a casino, you should grind it out. Don't fall so much in love with a company or stock that you disregard warning signs and red lights. Or, even if companies are performing well, you have to understand that there's risk involved. If you're putting money into the stock market, then you need to understand that that money could go away. You shouldn't overextend yourself with money that you're going to need within the next 6 months or a year. Don't let fear or excitement determine when you're pulling money out or putting money in. You have to make solid decisions based on the facts. So just maybe the best decision for you is to use a robo-advisor brokerage firm that's going to develop an investment strategy catered to you. And lastly, a lot of folks put people who play the stock market in one of three categories: investors, traders, or speculators. Investors are playing the long game. They understand that time in the market allows them to catch that overall upward trend. For an investor, all the work goes in prior to making that purchase of a share. After that, they set it and forget it. Traders are a lot more active. They're doing that research, but they're getting in and out, buying and selling stocks. They have the potential to make money a lot faster, but they also put themselves more at risk because of the volatility of the market. If they time it wrong, they can be looking at much bigger losses. They have to really be doing their homework and keeping an eye on the trends. The most extreme cases of this are day traders. They're literally sitting at a computer, looking hour by hour and even minute by minute to try to make moves. And then there's speculators. Of course, you believe that every share you buy is going up, or else you wouldn't purchase it. But speculators are willing to take a little bit more risk for a lot more reward. In evaluation, they might not necessarily see the fundamentals, but for some reason they see a lot of potential, and they're going to ride that out. So there you have it. Some basic concepts that you really need to understand so that you can feel confident going into the market. Obviously, the topic of investing is huge, and we can and will spend entire episodes on different aspects of investing in the stock market. In the future, we can touch on dividends, options, and definitely compounding interest. But for now, I just want you to get the basics. I hope these concepts make sense. If you have any questions or comments, make sure you leave them in the comment section below. And if you made it all the way to the end of the video and you enjoyed the content, remember, I ask you to like and subscribe to the Road program. We got some great projects in the works. I'll make sure I preview those projects on the Facebook page. And until then, we're out.